On July 1, 2021, OPEC Plus delegates had been in negotiations for 6 days. The meeting should have lasted one. What stopped it was a single line in a quota document. The UAE's production reference baseline, the number against which its OPEC Plus ceiling was calculated, was still pegged to 3.17 million barrels per day, a figure set in 2018 before Abu Dhabi had quietly expanded its actual production capacity to somewhere above 3.8 million barrels. The UAE delegation refused to ratify a new supply agreement locked to the old number. No deal was signed. Brent crude moved on the news, and for the first time in years, the structural tension inside OPEC Plus had surfaced where anyone could read it. That was not a diplomatic incident. It was an audit result. To understand what that standoff actually revealed, you need to understand how OPEC Plus functions as a system, and specifically where its incentive architecture quietly stops working. OPEC Plus's logic is straightforward on paper. Member nations agree to production ceilings. Collective output stays controlled. Prices stay elevated. Revenues stay predictable. Simple. Saudi Arabia, as the cartel's largest producer and de facto enforcer, has historically absorbed the deepest voluntary cuts when markets softened. Between 2020 and 2024, Riyadh reduced output at various points by more than 2 million barrels per day. That sacrifice only produces a rational return if the resulting price premium offsets the lost volume. The International Monetary Fund has estimated Saudi Arabia's fiscal break-even oil price, the price at which the government's budget balances, at approximately $80 to $85 per barrel for 2024. That number is not static. It has steadily risen since Crown Prince Mohammed bin Salman announced Vision 2030 in April 2016. The program, a restructuring of the Saudi economy on a scale that has no clean historical precedent, requires sustained capital deployment into NEOM, the Red Sea tourism corridor, industrial zones, and a domestic workforce transition away from public sector dependency. Every phase of that program is financed in the interim by oil revenue. There is no alternative funding mechanism at the required scale, not yet. Now, here is the first anomaly the document trail flags. Saudi Arabia's non-oil revenue as a share of total government income was approximately 38% in 2023, according to IMF data. Progress, but still short of the Vision 2030 target of 50% by 2030. The gap is currently bridged by Aramco dividends and sovereign borrowing. Aramco paid approximately $97.8 billion in base dividends in 2023, with additional performance-linked payments, the majority flowing to the Saudi government. That payout structure requires two things simultaneously: high production volume and elevated oil prices. The UAE's behavior is applying pressure to both variables, and that leads to the real question. Why Riyadh has tolerated that pressure for this long is the question this analysis will reach in Section 5. Abu Dhabi National Oil Company, ADNOC, has been operating on a different timeline. Since 2018, ADNOC has invested aggressively in upstream capacity, publicly targeting 5 million barrels per day by 2027. Industry estimates place UAE production capacity at approximately 4.2 million barrels per day as of 2024. The current OPEC Plus quota constrains UAE output to roughly 2.9 to 3.2 million barrels per day, depending on the specific agreement period. That is a gap measured in hundreds of thousands of barrels. Oil that exists has been drilled that Abu Dhabi is paying to leave in the ground. For any producing state, stranded capacity carries a cost. For the UAE specifically, that cost is structural, not just fiscal. Abu Dhabi's fiscal breakeven is estimated at approximately $65 per barrel, meaningfully lower than Saudi Arabia's. The gap is not incidental. The UAE has spent 2 decades building out its economy through finance, logistics, tourism, and free zone manufacturing. Oil revenue matters in Abu Dhabi, but a lower breakeven creates strategic flexibility that Riyadh simply does not have. A volume over price strategy is more attractive to the UAE than to Saudi Arabia. For the same reason, a cash-rich company can afford to undercut on margin while a leveraged competitor cannot. This is the decision chain the 2021 standoff made visible. If you are the UAE, OPEC Plus discipline imposes a concrete monthly financial loss. The delta between your production capacity and your allocated ceiling, multiplied by the prevailing price. If you are Saudi Arabia, any erosion of that discipline risks a price collapse that directly undermines the budget arithmetic behind Vision 2030. These two positions are not easily reconciled through diplomacy. They represent genuinely divergent national interests dressed in the language of cartel solidarity. Between 2022 and 2024, OPEC Plus managed this tension through rolling agreements that included modest quota adjustments for Abu Dhabi. Saudi Arabia continued to lead voluntary unilateral cuts, a strategy that effectively subsidized prices for all members, including the UAE, while Riyadh absorbed the volume cost alone. By mid-2024, Saudi production had been reduced to approximately 9 million barrels per day, well below its stated capacity of 12 million, to support prices against weak Chinese demand and rising non-OPEC supply.
The clearest structural signal came in June 2024, when OPEC Plus agreed to begin gradually unwinding its voluntary production cuts, starting cautiously in late 2024, with a pathway towards restoring approximately 3.66 million barrels per day of previously withheld supply by end of 2025. The UAE secured quota increases within that framework. The announcement pushed Brent crude below $80 per barrel on multiple trading sessions.
For Saudi Arabia, every sustained week below $80 is a budget event, not an abstraction. With a projected 2024 fiscal deficit estimated by the IMF at approximately $21 billion at prevailing prices, Riyadh's tolerance for prolonged price weakness is narrow. NEOM's construction schedule, the line, the Red Sea project, these programs do not pause cleanly. Contracts are active, consultants are deployed. The financial architecture of Vision 2030 was built on a price assumption that the UAE's production strategy is now actively testing from below.
In late 2024, internal communications cited by both the Wall Street Journal and Reuters indicated Saudi officials had expressed frustration to OPEC Plus counterparts over compliance gaps. Several member states were reportedly producing above stated ceilings. The cartel's enforcement mechanism, which has always been reputational and diplomatic, not legal, was visibly under strain. OPEC Plus has no compliance court. It has leverage, history, and shared interest. When those three stop aligning, the mechanism breaks.
Here is where the anomaly from Section 2 resolves. Throughout this period, UAE officials maintained public messaging consistent with OPEC Plus unity. Simultaneously, ADNOC was signing upstream expansion contracts that only generate a financial return if Abu Dhabi expects to produce at significantly higher volumes within this decade. The International Energy Agency has documented the structural pressure the energy transition places on all hydrocarbon exporters. The window for maximum oil monetization before electric vehicle adoption and renewable penetration reduce structural demand growth is modeled to narrow significantly after 2030.
That deadline creates a strategic logic that is almost mechanical. If you are an oil producer with large reserves, low extraction costs, and a manageable fiscal breakeven, the rational move is to accelerate production while demand can still absorb it. The UAE's behavior follows that logic precisely. Saudi Arabia's Vision 2030 also follows that logic. It is, at root, an attempt to monetize oil wealth before the transition closes the window. But the vision's timeline requires stable prices to fund the transformation, not maximum near-term volume. These two rational strategies, executed simultaneously by neighboring states within the same cartel, generate the structural contradiction OPEC Plus is currently managing.
The historical parallel is not subtle. In the early 1980s, OPEC quota discipline deteriorated as member states facing fiscal pressure quietly exceeded their ceilings. Prices fell from above $30 per barrel in 1980 to below $10 by 1986. Saudi Arabia, attempting to enforce discipline, eventually reversed course and flooded the market itself. Prices collapsed further. The cartel's pricing leverage did not meaningfully recover for more than a decade. The mechanism that produced that outcome has not been structurally revised since. Cartels built on voluntary compliance rather than binding enforcement are structurally vulnerable to rational defection when member incentives diverge sufficiently. OPEC Plus's architecture provides no mechanism to compel a major producer whose national interest calculus has shifted. The 1986 precedent demonstrated that downside. The current divergence between UAE and Saudi incentives is not identical, but the underlying structure rhymes closely enough to warrant the comparison. Personal action for 2025 to 2026. If you carry any exposure to energy sector equities, commodity-linked assets, or macro positions sensitive to Gulf fiscal stability, monitor the spread between Brent crude and Saudi Arabia's estimated fiscal break-even price. When that gap compresses sustainably below $5 per barrel, the pressure on Vision 2030's funding architecture becomes acute, and the political incentives inside OPEC Plus shift toward the kind of unilateral calculation Riyadh made in 1986. The spread is a more informative variable than the official production announcements. One question this analysis cannot cleanly resolve: at what price level and over what duration does Saudi Arabia calculate that enforcing OPEC Plus discipline costs more than abandoning it? Riyadh has absorbed the swing producer burden, cutting output, subsidizing cartel prices, foregoing volume for most of this decade. That posture has a rational limit. When the IMF publishes updated break-even estimates, and when ADNOC announces its next capacity milestone, those two data points together tell you more about OPEC Plus's stability than any summit communique will. If the governance mechanics of resource cartels interest you, Libya's quota disputes in the early 2010s prefigured this exact fracture pattern, and the structural comparison to the current UAE position is closer than the geopolitical distance between the two cases suggests. That analysis is coming. Which piece of this evidence chain, the fiscal break-even divergence, the UAE capacity gap, or the compliance enforcement problem, do you think OPEC Plus observers should have flagged as the primary warning signal? Argue your timeline below. I'll cite the strongest breakdown in a follow-up. And if structural analysis of resource politics is what you track, no hype, just the paper trail. Subscribing keeps this in your feed.